Good morning, everyone, and welcome. I call this meeting of the NCUA Board to order. In addition to those joining us in the boardroom today, I want to note for the record that this meeting is open to the public through a live webcast on www.ncua.gov. If you would like to view the closed captioning for this meeting on your computer, please click the CC icon located in the lower left corner of the WebEx window. You may also change the layout setting by clicking the layout option on the top right side of the screen. Our recommended viewing option for this meeting is the stack mode. Before we begin our business, I think it's important that we take a moment to observe the 75th International Credit Union Day. Launched in 1948, this day is a time for all of us, credit union members, credit unions, other financial cooperatives, and regulators like the NCUA, to recognize the global impact of the credit union movement. I've seen that impact firsthand within my family. Many of you do not know that my grandfather helped to start a credit union at a soap factory in Indiana. Years later, my dad contributed to the chartering of a teachers' credit union in Illinois. Those credit unions helped my family to achieve economic stability. And each of those credit unions, like thousands more of them around the country and across the world, began with a small group of people pooling their financial resources together to envision a brighter financial future for their families, friends, and coworkers. The statutory mission of federally insured credit unions in the United States is to meet the credit and savings needs of their members, especially those of modest means. So it's fitting that this year's International Credit Union Day theme is Empower Your Financial Future with a Credit Union. We've long been working toward that goal at the NCUA by chartering new credit unions, expanding access to financial literacy resources to assist consumers in making smarter financial decisions that will improve their financial well-being. And we have been facilitating the ability of credit unions to meet the financial needs of underserved populations and places around the country. At the NCUA, each one of us contributes to ensuring the stability of our economic and financial system by making it more accessible and equitable. We are also ensuring the availability of safe, fair, and affordable financial products and services. And when coupled with the work of thousands of credit unions that we regulate and insure, we are together supporting the financial well-being and security of 133 million credit union members across the country. Thanks to all who are making a difference in the world. Vice Chairman Hoffman, I understand that you have a few words.
You bet. On International Credit Union Day, I want to just mention that credit unions are something, like a lot of things in this country that are terrific. They came from abroad. They came from immigrants. They were Quebecois who came over to New Hampshire and started the first credit union. So we can thank immigration and people bringing their ideas from abroad for the thing that benefits so many Americans today. And I'll finish with this. For many Americans around the world, credit unions are the only form of democratic control that they will ever know. It's fitting that we recognize those contributions today. Back to you.
Thank you so much. Board Member Hood.
Thank you, Mr. Chairman, and it certainly is my honor to acknowledge and celebrate International Credit Union Day. I'm very pleased, you all, that we, with our 133 million members of credit unions in the United States, they join 200 million other member owners throughout the globe who all are looking to their financial institution for affordable products, for opportunities to have greater and broader financial inclusion. You all had an opportunity to see this play out this summer when I went to the World Council of Credit Unions Global Conference there in Scotland, where I was able to meet with other regulators and other credit unions that we were all able to talk about the people helping people ethos. And you all, I know we often say it here, but we got a chance to see it play out with many of the individuals there that I met with from the Cooperativas in Latin America, the SACOs from Africa, and the Building Society representatives there from the UK. So we all are so fortunate to have a part of a global movement that really is leaving an indelible mark in many of the communities that, were it not for credit unions, these communities would be financial deserts. As we talk about International Credit Union Day today, I also would be remiss if I didn't mention we will be having at our November meeting, if all goes according to schedule, representatives from Africa who are the African regulators throughout the continent. So we at NCUA are working with the World Council to bring at least 20 African regulators from throughout the continent to join us to see us with our democracy in action through the NCUA board. Thank you, Mr. Chairman.
Thank you, Board Member Hood, not only for those insights, but your leadership in bringing that delegation over here, as well as your leadership on the Access
Thank you.
Initiative. You really have been at the forefront of financial inclusion. I know it's a hallmark of
Thank
your
you.
leadership, so thank you. Now, turning to our agenda, the first item of business today is a board briefing on cybersecurity. Kelly Lay, Director, Office of Examination and Insurance. Ernie Chambers, Critical Infrastructure Division Director, Office of Examination and Insurance. And Amber Gravius, Director, Office of Business Innovation, will present today. You're welcome to come to the table, and you may begin whenever you are ready.
Good morning, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. This is Kelly Lay, Director, Office of Examination and Insurance, and joining me today is Ernie Chambers, Critical Infrastructure Division Director in the Office of Examination and Insurance, and Amber Gravius, Director of the Office of Business Innovation. It is our pleasure to present the semi-annual cybersecurity briefing covering the period from this past April to present. First, Ernie will brief you on changes in the cybersecurity threat landscape, the need for credit unions to maintain cyber hygiene, and other efforts that the agency is taking to help the industry enhance its cybersecurity posture. Amber will then close out the presentation by sharing our Cybersecurity Month awareness activities.
Great.
With that, I'll turn it over to Ernie.
Thank you, Kelly. Next slide, please. Cybersecurity risks remain a significant threat to the financial system. Geopolitical issues continue to drive decisions related to cyber. Pro-Russian hacktivists continue to target government and private interests, including those in the financial sector, with cyber attacks in countries supporting Ukraine and the expansion of NATO. Most of these attacks have targeted European entities outside the financial sector, suggesting financial firms may not be the primary focus of these endeavors. Also, given China's close relations and support for Russia, during the last decade, the war in Ukraine likely will become a sustained priority for Chinese threat groups. At least 2 unique Chinese state-sponsored actors targeted Ukraine before and after Russia's invasion, and it was observed that a 3rd Chinese group is targeting European organizations with the Ukraine-related lure. Suffice it to say that as long as the conflict continues, these cyber threats will continue. Because of the threat actors being financially motivated, credit unions should remain vigilant and monitor and protect themselves against these activities. This is especially important as credit unions and businesses are increasingly moving from cloud to multi-device and hybrid environments, and back and forth as their business and operational needs dictate. These changes result in their exposure changing frequently and, in some instances, increasing. Each and every time a new server or device is added to the network, a new potential risk is also added. With threat exposures being so dynamic, credit unions, their vendor partners, and other business partners should continuously measure and monitor their risk. Prudent risk management is not a one-and-done activity, or even a once-a-year checkbox activity. To effectively protect against evolving cyber threats, cyber risk management must be a part of the continuous risk assessment and management process. These briefings allow the NCUA to share information on evolving cyber-related risk and trends with both the NCUA board as well as with the credit union industry. To further aid credit unions with managing evolving risks, the NCUA also provides guidance and cyber alert notifications for rapidly evolving threats. This morning, I will focus on the following specific cyber topics and how these threats or risks might impact the credit union industry. Ransomware and cloud migration, DDoS or distributed denial of service tactics and techniques, and decentralized finance. I will also review some basic cyber hygiene practices all credit unions and their vendors should be employing. Next slide, please. Ransomware continues to pose a major threat. While talking about ransomware, I'm going to simultaneously call your attention to the tangential concerns of cloud migration. According to security vendors, there is an increase in attacks in Linux-based systems which targeted cryptojacking, malware, and vulnerability exploits. Threat actor interest in Linux-based servers and technologies has ramped up significantly. That's likely in response to a growing enterprise use of Linux infrastructures, especially in the cloud, to host mission-critical applications and data. According to Trend Micro's mid-year roundup report, in the first half of 2022, there was a 75% increase in ransomware targeting Linux systems compared to the same period last year. Reportedly, the trend is being driven by the operations of the Revil or Revil and DarkSide ransomware families, and attacks are gaining momentum with the release of a Lockbit ransomware variant for Linux and VMware systems. While ransomware continues to be the biggest, it is not the only threat targeting Linux systems. A report that VMware released earlier this year noted an increase in cryptojacking and the use of remote access Trojans or RATs designed to attack Linux environments. The threat actors are using malware such as XMRig to steal CPU cycles on Linux machines to mine Monero and other cryptocurrencies. Highlighting this is important for several reasons. First, credit unions are beginning to look at offering distributed ledger services to their members, and secondly, because Linux is increasingly being used within critical areas of the business computing infrastructure environment, especially in the cloud environment. Because Linux is a common operating system across multi-cloud environments, successful attacks on these systems could cause considerable harm across the critical infrastructure landscape, financial services, and credit unions not excluded. The price of ransomware attacks is also on the rise, with the average ransom demand reaching $220,000 in 2021. Associated recovery costs can reportedly reach up to $1.8 million. Therefore, securing against ransomware threats is of paramount importance for almost all information security teams. And for that reason, organizations should integrate penetration testing to confirm that defenses and security procedures are functioning properly. Ransomware operations not only affect credit unions, but also third-party providers, including managed service providers, MSPs, and backup service providers. The credit union industry relies heavily on these service providers. An example of a specific issue for managed service providers involves threat actors exploiting a vulnerability in backup software that then is used to deploy ransomware. Threat actors such as Conti, Lockbit, Phobos, and Wickerme have each been associated with incidents attempting to delete shadow copies, backups, virtual machines, and snapshots, as well as activity to prevent restoration of backups and forensic analysis of their activity. Credit unions need to protect against this threat. The Cybersecurity and Infrastructure Security Agencies, or CISA's StopRansomware.gov, offers a one-stop shop for resources including alerts, guides, fact sheets, and training, all of which is focused on reducing the risk of ransomware. CISA and the Multi-State Information Sharing and Analysis Center's Ransomware Guide provides high-level prevention, best practices, and a response checklist. NIST provides similar best practices to the ones listed in the MS-ISAC Ransomware Guide related to data integrity and combating against ransomware. Given the criticality of backups in disaster recovery, organizations should consider implementing these steps to secure these systems, enforcing multi-factor authentication, and storing any relevant secrets and keys offline which can reduce the likelihood that a malicious actor can access backups, even if they compromise the enterprise network and valid credentials. Creating redundant backups, encrypting backup data in transit and at rest, and storing backups off-site and offline are also encouraged. Credit unions should know and understand what practices their managed service providers are employing to protect their data. Next slide, please. DDoS, or distributed denial of service attacks, do not appear to be going out of fashion. In fact, they remain high on the list of tools utilized by bad actors. Remember, the main purpose for a DDoS attack is to make a website inaccessible using botnets. Throughout the years, DDoS attacks have evolved far from their experimental beginnings. Large enterprise companies such as DNS, GitHub, and Google, notwithstanding, have all gotten hit hard in recent years. However, there has been a shift towards targeting small and medium-sized businesses, which signals an increased concern for credit unions. This noticeable change in targeting, as well as tactics, techniques, and procedures used by attackers to orchestrate these blitzes, has taken the form of DDoS extortion, application assaults, and targeted attacks against internet-facing infrastructure. This change in attack vector is another reason why it is important for credit unions to maintain their cybersecurity preparedness and vigilantly monitor their internet traffic and firewall security. Credit unions should also have a plan and procedures in place to mitigate a DDoS attack if and when that happens. Next slide, please. The next cyber topic relevant to the credit union industry is the use of decentralized finance, or DeFi, platforms and some recent incidents of cryptocurrency thefts. Credit unions have shown interest in offering distributed ledger technology and cryptocurrency for their members. As with any new technology and service, there are risks. The NCUA outlines some of these risks in Letter to Credit Unions 22-CU-07, titled Federally Insured Credit Unions Use of Distributed Ledger Technologies, which was issued in May of this year, calendar year 2022. How is decentralized finance being exploited? The protocols for these emerging technologies are built on top of cryptocurrency platforms and can be exploited by blockchain-savvy hackers looking to profit off technical and financial vulnerabilities. As with any other banking technology that uses the internet, protocol weaknesses coupled with insufficient security and authentication have allowed the blockchain-savvy hackers to steal funds. Credit unions considering engaging in these activities and services are any emerging technology should perform thorough third-party due diligence and conduct risk assessments to fully ensure they understand the risk of the activity. As part of their due diligence, credit unions should ensure any decentralized finance platform they consider is accounting for traditional cybersecurity concerns on top of continually emerging issues. We encourage credit unions to review NCUA's letters to credit unions when considering the use of distributed ledger technology. Next slide, please. One risk management practice related to mitigating cyber risk is to have established cyber hygiene practices. These are the practices organizations and individuals perform regularly to maintain the health and security of users, devices, networks, and data. The goal of cyber hygiene is to keep sensitive data secure and protected from theft or attacks. The benefits of cyber hygiene speak for themselves. In a nutshell, they minimize the risk of operational interruptions, data compromise, and data loss by improving a credit union's overall security posture. Poor cyber hygiene can lead to security incidents, data compromise, and data loss. Maintaining good cyber hygiene is critical to reducing a credit union's risk, but are far from easy. Common challenges include the breadth and complexity of IT environments. In today's credit unions, the sheer volume of users, devices, and assets, often distributed across hybrid and multi-cloud environments, makes maintaining proper cyber hygiene extremely challenging. Monotony. As an objective, cyber hygiene can never be completed and crossed off of a list. Rather, it requires security practitioners and end users to routinely engage in a never-ending stream of important but often mundane and easily neglected behaviors and tasks, such as not writing or recording passwords. User buy-in. IT security teams can't achieve good cyber hygiene on their own. They need the support and engagement of end users throughout their credit union, including those with little expertise or interest in cybersecurity. Some basic cyber hygiene practices everyone should use include single sign-on, endpoint protection, patch management, encryption, backups, password hygiene, and multi-factor authentication. Next slide, please. Even as we work collaboratively to protect credit unions against cyber risk, an incident still may occur. As such, I'd like to briefly touch on the NCUA's proposed cyber incident notification rule. President Biden signed the new law on cyber incident reporting in March of this year. This law requires CISA to implement regulations that require critical infrastructure owners and operators to report major cyber attacks to CISA within 72 hours and ransomware attacks within 24 hours. In July, the NCUA proposed a rule to align with this reporting requirement, which would only require a federally insured credit union to notify the NCUA as soon as possible, but not later than 72 hours after they reasonably believe that a reportable cyber incident has occurred. The NCUA's proposal was structured to align with regulations that will be developed by CISA. The 60-day comment period for the proposed rule ended on September 26, 2022. Agency staff are in the process of evaluating comments and suggestions for the final rule. Related to this new law and its reporting requirement, the Department of Homeland Security is leading the Cyber Incident Reporting Council, comprised of many government and regulatory agencies. This council, of which the NCUA is a member, is collaborating on ways to create a harmonized reporting structure for providing incident information to CISA, who will use that information to rapidly deploy resources to victims under attack and share information with network defenders. The goal is to create a smart regulatory apparatus that doesn't create problems for the private sector or unnecessarily burden anyone with duplicative reporting. We'll periodically update you on this as the Council's efforts mature and evolve. Next slide, please. Now I'd like to provide a brief update on our new information security exam program. This past year, field examiners tested the agency's new information security exam program. Feedback and improvements to the program were continuously implemented throughout the test period, which recently ended on September 30th. The program is scalable for credit unions large and small and aligns with the Automated Cybersecurity Evaluation Toolbox, or the ACET toolbox, found on the NCUA website. This means credit unions using the toolbox to evaluate their cybersecurity posture should not have any surprises when receiving their examination, as they would already be aware of their information program strengths and weaknesses. Field examiners completed approximately 250 credit union examinations this year using the new program. The core risk-focused exam and small credit union program modules guide examiners through assessment statements tailored to a credit union's size and complexity of operations. The assessment statements also include sources and reference citations that examiners can share with credit union staff that aids in credit union program compliance and improvement. Feedback from both examiners and credit unions has been positive. The final version of the new exam program is planned for deployment by the end of the fourth quarter 2022. Next slide, please. The NCUA continues to participate and partner with industry and interagency organizations to raise awareness of cybersecurity risks to the credit union industry by supporting outreach events, providing training, providing assessment tools and other resources on NCUA's Cybersecurity Resources webpage, and publishing cyber alerts and notifications to credit unions. As part of its efforts to support cyber preparedness, the NCUA also participates in a variety of tabletop exercises with the government agencies, banking regulators, and state supervisory partners to aid in testing credit union preparedness. These tabletop exercises explore realistic scenarios and help the public and private sector understand how each is likely to respond to incidents and to identify gaps amongst and between the two sectors. These exercises also allow participants to work through possible mitigation and remediation options in a controlled setting. Related to partner engagement and to prepare for an emerging risk, CISA began hosting industry discussions on the risk associated with post-quantum cryptography. The first meeting was on September 26th. While developments in quantum information science have the potential to drive innovation across the economy, as with any new technology, such developments also pose a risk to the economic and national security of the United States. A quantum computer of sufficient size and sophistication threatens the security of asymmetric cryptography, which is ubiquitous throughout our critical infrastructures. Although the exact timing for the arrival of a quantum computing device is not known, the threat to information protected by asymmetric cryptography exists now because an adversary can collect and store encrypted data now for decryption and exploitation in the future when quantum computing capabilities do become available. The September meeting was the first in a series of semi-annual meetings that CISA plans to hold to discuss this emerging risk. Credit unions are invited to participate in these meetings to hear directly from CISA about the government's efforts to support industry around this emerging topic and to ask questions and provide comments. Next slide, please.
All right, thank you, Ernie. I'd like to start by highlighting that October is Cybersecurity Awareness Month. This year, the national theme is See Yourself in Cyber. Throughout the month, the NCUA has been and will continue to highlight on social media platforms such as LinkedIn, Twitter, and Facebook key action steps everyone should take, including, but not limited to, enabling multi-factor authentication, using strong passwords, recognizing and reporting phishing, and updating software. On October 13th, 2022, the NCUA held a webinar on ransomware in the financial sector. This webinar featured staff from the NCUA's Office of Credit Union Resources and Expansion and the Office of Examination and Insurance, moderating the panel featuring the FBI Cyber Division, the Office of Credit Unions, Wisconsin Department of Financial Institutions, and the Treasury Department Office of Cybersecurity and Critical Infrastructure Protection. The webinar is archived on the NCUA's YouTube channel and will be available in the Credit Union Resources and Expansion's Learning Management System. A strong cybersecurity posture is dependent on people, systems, and controls working in tandem. While cybersecurity may seem like a complex subject, it's really about the people. Providing resources and educating people on how to protect themselves online as threats to technology and confidential data is necessary to ensure individuals and organizations make smart decisions, whether on the job, at home, or at school, now and in the future. When CISA says see yourself in cyber, it means see yourself in cyber no matter what role you play. As an individual or consumer, take basic steps to protect your online information and privacy. The NCUA is also continuing to emphasize the importance of shields up or maintaining a heightened cybersecurity posture to protect against malicious attacks. Credit unions, their vendors, and suppliers can take ownership of their role while protecting their brand, members, and reputation by ensuring they have strong cybersecurity in place. This will help prevent an incident for their members, at the credit union, and further down the supply chain. This concludes our presentation. We are happy to answer any questions you may have.
Thank you so much, Amber, Ernie, and Kelly, for your informative cybersecurity briefing. And as Amber noted, this is National Cybersecurity Awareness Month, so it is a good time for everyone in the credit union system and at the NCUA to recommit to maintaining resilience and readiness in responding to ever-changing cybersecurity threats and risks. Robert Morris, the National Security Agency cryptographer and computer scientist who contributed to the development of the Unix operating system and pioneered many of today's cybersecurity practices, once said, "The three golden rules to ensure computer security are do not own a computer, do not power it on, and do not use it." If it only were that simple. Today's modern, global, and interconnected financial services sector relies on the power of information technology and systems, and shutting down those systems is not feasible because nearly every federally insured credit union relies on credit unions, has a website, or interacts electronically with members and third-party vendors. Morris's prophetic words do not mean it is futile to defend against cybersecurity threats. Rather, those words are an appreciation of the eventuality of cyber attacks, and they highlight the urgent need to stay ahead of perpetrators. As Ernie noted, phishing, ransomware, and distributed denial of service attacks are just some of the many ways cybercriminals exploit vulnerabilities within the credit union industry and the financial system. The changing nature of work, like hybrid working environments, and the greater use of remote work have also increased the number and types of cyber risks for which organizations must account. Lastly, geopolitical tensions around the globe also raise the specter of cyber attacks against our nation's financial services industry and other critical infrastructure. I've often said that the credit union system cannot and must not be the soft underbelly that endangers the broader financial system and our economy. Each of us, the NCUA, state supervisory authorities, as Amber noted, vendors, and credit unions, has a responsibility to protect our systems, improve our ability to recover from incidents, educate our teams, share information, and report and address potential vulnerabilities. Our chain is only as strong as our weakest link, so we all must be hypervigilant to prevent a catastrophic failure. My first question is for you, Ernie. When I speak with credit union leaders about cybersecurity, I often talk about bad actors probing systems and networks looking for vulnerabilities. Is that trend continuing, and has it intensified since the start of Russia's war on Ukraine? And should credit unions continue to be vigilant against that threat?
This is Ernie. Thank you, sir, for that question. Indeed, bad actors and cyber criminals are now and will continue to scan and or probe our networks. Scanning or probing is the initial step or stage for a bad actor. Anyone connected to the internet will experience these events, even credit unions. Bad actors are trying to determine if there are weaknesses or vulnerabilities in the credit union's security or networks that can be exploited. These specific scans or probes can be unique and are designed for the type of malware that bad actors are trying to deploy. Most simply put, if a vulnerability or weakness is identified and can be exploited, the bad actor will deploy an attack such as malware. Malware comes in many forms, from keyloggers, worms, rootkits, and ransomware, just to name a few. Credit unions need to know that cyber threats continue to be pervasive and are evolving and have intensified. Since the start of the war, bad actors like to follow the money, so they will continue to be a target. To protect themselves from being targets, credit unions need to remain vigilant with their network monitoring and maintain a heightened cybersecurity state of preparedness. This brings us back to exercising good cyber hygiene practices, which I highlighted earlier in the briefing. That concludes my response.
So Ernie, if I were to take it and just drill down exactly what you just said, I think it can be summed up as this. We're seeing probing occurring, and just because an attack hasn't occurred yet doesn't mean an attack, won't happen in the future, and we all need to stay on top of this. Is that?
That is correct, sir.
Great. Thank you for emphasizing that point and reminding us of the continued need to monitor for those very real threats. As noted in the briefing, the NCUA will soon launch its new Information Security Examination Procedures, or ICE for short. This new examination program offers flexibility for credit unions of all asset sizes and complexity levels, while providing examiners with standardized review steps to facilitate advanced data collection and analysis. These new ICE procedures will assist the credit union system in preparing for, withstanding, and recovering from cybersecurity threats. My next question is, I don't know if it's for you, Kelly, or for Ernie, but would you provide additional details about the new ICE examination program? I believe, Ernie, what you talked to that we would have a streamlined system for smaller credit unions, a core system for larger credit unions, and then a core plus system for the largest of credit unions. But what are those thresholds? What can credit unions expect with ICE?
Thank you, Chairman Harper. This is Kelly, and I'll take that question. So you're correct. The Information Security Exam Program is tailored to a credit union's size and complexity. So our smaller credit unions will have a more streamlined examination, and our larger credit unions may experience a deeper dive into like systems, networks, and controls. The new ICE program was built around the same content and knowledge used in today's IT exam. So the current IT exam consists of 20 questions. Those questions right now provide little guidance and expectations for our examiners and our credit unions. And that's really what led us to develop the new Information Security Exam Program. And so that new program is built around those 20 questions, but it aligns with the ASET, that automated cybersecurity examination toolbox that's found on our website. So credit unions should really know what to expect with this next exam because it aligns directly with that toolbox. So we don't expect any surprises there.
Okay.
And that concludes my response.
And smaller credit unions, did we draw the line at 50 million there, or was there some other threshold?
50 million is the threshold for the smaller.
And there really isn't a threshold for when you move from core to core plus, because
It really is dependent on the services they offer, the products that they offer, and just their complexity overall.
And just one last question. I assume it's going to be our general examiners that are going to be using the ICE program, that our regional information specialists and our national information specialists are going to do deeper dives on particular issues.
Exactly. So the smaller credit unions will likely see the general examiners doing those, SKU up procedures, whereas more of our specialists or our national specialists will be doing the core and the core plus.
Great. Hey, Kelly, thank you for explaining that. Stakeholders look for additional information and guidance on the new ICE procedures in the coming weeks. Credit unions can also find further information and resources to strengthen their preparedness by visiting the NCUA's Resource Center at ncua.gov/cybersecurity. Yesterday, we held a hearing to discuss the NCUA's staff draft budget for 2023 and 2024. We spent a considerable amount of time discussing the resources the NCUA needs to allocate for cybersecurity activities and staff. Like the NCUA, credit unions are currently setting their budgets for next year. Is there a rule of thumb as to how much a credit union should spend on cybersecurity?
So that's a great question. This is Ernie. As with any component of business, there are a lot of factors that influence how one would build a budget, cybersecurity notwithstanding. A few key considerations being rooted first and foremost in a good and sound risk-based assessment or risk management program. Understanding one's threat or risk profile relative to the size, scope, and complexity of the institution, as well as its compliance, regulatory mandates, sensitivity of the data it both collects and stores, are all key contributing factors.
Sure.
There's no one size that fits all, but taking the four into consideration should help in determining what is appropriate for any particular institution's risk tolerance, which should be the driver for those budgetary allocations.
It should be the driver. I mean, we can't expect a credit union with 7 employees to have a dedicated cybersecurity IT expert. But what if they're getting closer to 100 employees? Should they maybe have an expert on their staff at that point in time?
Sir, I would, this is in Ernie's opinion, the recommendation would be yes, but there are many services that can be, there are virtual CISOs that are available in our space that can be purchased for, I won't say pennies on the dollar, but significantly, significantly less than. Yes.
I think if anything, this board, one of the things this board has learned is cybersecurity does not come cheap.
No.
At all. In closing, I want to turn back to Robert Morris. In addition to his recommendation to unplug completely to ensure computer security, he also noted that to protect information, one has to be paranoid. The outlook can easily be interpreted as alarmist. However, that sentiment is anything but crying wolf. It is the reality of what it takes for all of us to protect credit union members, institutions, and systems. Cybersecurity is what keeps me up at night, and I know I'm not alone. The stakes are high, our adversaries are diverse, inventive, and relentless. So I urge all stakeholders within the system to continue fighting the good fight by innovating and adapting to a constantly shifting landscape where cyber threats know no borders. I look forward to continuing to work on cybersecurity with Vice Chairman Hoffman and Board Member Hood. That concludes my remarks. The Vice Chairman is now recognized.
Thank you, Mr. Chairman. Thank you, Ernie, Amber, Kelly, for your presentation. The cyber landscape continues to evolve with new threats. The current geopolitical situation only adds to the challenge. The fact that bad actors are targeting mid-sized businesses underscores that large or small credit unions must be vigilant. No one is exempt, and risk management must be continuous. Since our last update, NCUA issued a letter to credit unions on the use of distributed ledger technology. I know many credit unions were grateful for the clarity that letter provided. As I've noted in the past, traditional finance, or TradFi, is already being disrupted by decentralized finance, or DeFi. So for some, staying ahead of that disruption may mean embracing and deploying elements of DeFi. While our letter on the use of distributed ledger technology clarified NCUA's position, I want to say it should be noted that our guidance is no substitute for thorough third-party due diligence. This is on the credit unions, always will be. It is the credit union's responsibility to ensure that their decentralized finance platform and partners address security, authentication, and other risks. At our last update, you noted that you were piloting our Information Security Examination Tool, ISE, for the field staff. Congratulations on getting that done last month. We also learned more about the Automated Cybersecurity Evaluation Toolbox. Are we calling it ASET? Is that what we're calling it? Okay, ASET. I am gratified to learn that your team continues to work on the alignment between those two things. The extra effort to align the tools will not only assist credit unions to build out their cybersecurity systems, but will provide them with elements of what they can expect during an exam. I hope more credit unions will take advantage of ASET and other NCUA resources, such as our webinars, roundtables, etc. I urge credit unions to check out NCUA's cybersecurity resources webpage for more information. I'll mention when I speak to groups, it's frequently a lot of things that people get asked about. We have done a webinar, there is something out there, maybe we could do a better job of pushing it to them. But frequently a lot of the questions people ask, we've answered in some manner. Maybe we haven't marketed it, but we've answered it. So I have a question for you guys. You mentioned the cyber incident rule passed in July. The comment period for that, the proposed rule, ended September 26th. What ways was the proposed rule structured to align with CISA reporting?
This is Kelly, and I will take that question. So you're correct. The cyber incident rule was structured to align with the CISA reporting, and I see two primary, major alignments. First, the proposed rule sets parameters for what constitutes a reportable cyber incident. So the definition of a reportable cyber incident really aligns well with the Cyber Incident Reporting for Critical Infrastructure Act. The other major alignment that I see is the proposed rule adopts the 72-hour reporting window, which is the same reporting window in that what I call the CISA Act. So really the intent of that notice of proposed rulemaking is to provide the NCUA with prompt notification of any cyber incident that rises to the level of a reportable cyber incident. That concludes my response.
Okay, thank you. Yesterday we had our budget hearing, and a woman from the Virginia Credit Union League mentioned that for all the talk about credit unions and their cybersecurity, their problem, the thing that costs them time and money, isn't that the credit union was hacked. Their problem is Target or somebody was hacked, and they have to make people whole on that. They're worried about pending rules from other agencies that would make them liable for things like Zelle, fraudulent payments, et cetera. How do we address the fact that when there's a credit union that has an actual cyber problem, it's often not that the credit union was hacked. It's their debit card or information was stolen in a vendor hack, in a retail hack at a gas station, a cloned card. Are we sure that it's the credit unions? What I'm trying to say is, again, I just want you to address the comments made yesterday. Basically, it's not us getting hacked, says the credit unions. It's Target or Wells Fargo, or whomever, that information getting out there. That's what costs them time and money. Can you address that, please?
Yes, sir. And actually, that's a great setup for anyone that understands the third party and supply chain problem. And that's what you just so well articulated. It is often not the case that it's the credit union that is directly being targeted, both those third as well as some fourth party providers. So the watchword, remain vigilant, and make sure there's a good risk management program that goes deep into your due diligence processes, even for those black swans that may come one's way.
All right, and I'll finish with this about our reporting rule. I know we gave them 72 hours, I believe, right?
Mm-hmm.
That's correct. And is that does not include, that's 72 hours in normal time, right? It's not business days or anything, right? It's just normal time.
Yes, sir.
Okay. And I'll just say this again, can we make sure that we provide some sort of physical cheat sheet they can print out? Vague regulations are bad regulations. This is reportable. This is not. It's not going to cover everything. We know that. And the reason I say physical print out is this is a scenario in which your internet may be down. Your email may be hacked, right? That's the world we're talking about here, right? This could be 2 o'clock in the morning. Do we have to follow the law here and report this? I'd want to have here's an example of what is reported, what is not reported, and here's how you report it. Here's the number, here's the email address, what have you, right? A couple different ways to report it, to make it simple. Again, vague rules or bad rules. We're going to do that?
Sir, I would leave that to the boss there to answer.
Yeah, we've talked about this, and I think that's a great idea, exactly for the reason that you said, is you get hacked, you need to have something that you can maybe pull out of your desk drawer, right, instead of having to log onto your computer. So we keep certain things, ourselves here at the agency, in terms of disaster recovery, of some things that we need to be able to get to, right, our COOP plan, when something happens that we can't maybe access our computer. I think that's a great idea as well for
In my
cyber
head, I
incident.
think of it as like a wallet card, an image in a folder on your phone, a thing taped out to your desk. You probably have it at home as well, because this could be happening at 3 o'clock in the morning or something like that. That concludes my comments. Back to Chairman Harper.
Thank you so much. Board Member Hood?
Great. Thank you, Chairman Harper, and thank you, Amber, Ernie, and Kelly, for today's very, very robust cybersecurity conversation. I would agree with the chairman, you all, that cybersecurity is one of those things that certainly keeps me up at night. I don't think I've gone to any type of credit union convening where I did not talk about the pervasive risks that come from cybersecurity attacks. In fact, a cyber incident that compromises data security is every business leader's nightmare. In recent months, news reports indicate credit unions in Florida, New Mexico, and across Canada, among others, have been targeted in cybercrime attacks. In an interconnected world, we simply can't take cybersecurity for granted. I'm delighted that we are having you all here today because this is, in fact, Cybersecurity Awareness Month. And I know, Ernie, during the briefing, I wish it could be Cybersecurity Awareness Year. But nonetheless, be that as it may, this is, though, a good time for NCUA to review cyber plans and procedures to ensure institutions are prepared to face a cyber event. In April, the NCUA's Critical Infrastructure Division provided the NCUA board with an update on today's threat landscape. We know that with today's geopolitical tensions, the risk of cyber warfare has grown exponentially. State actors like China, Iran, and Russia have previously launched disruptive and invasive cyber attacks against U.S. networks, both in the public and private sectors, and are likely to continue doing so in the days ahead. Likewise, Cybercriminal networks have evolved and become increasingly sophisticated in their operations. For example, a few years ago, I would say most of us worried more about data breaches than ransomware attacks, in which a threat actor seizes control of a system and demands a ransom to be paid. But IBM Security's 2022 Intelligence Threat Index found that ransomware attacks have emerged as now the most common type of a cybersecurity incursion. Such incidents bring high costs in the form of financial losses, lost time and productivity, and reputational damage. So credit unions should be asking if they have appropriate cyber hygiene and the appropriate control mechanisms in place. And of course, what may be the most likely threat for financial institutions, and particularly smaller institutions, is the insider attack, in which an employee or trusted vendor compromises an institution's data. That can be purposeful or inadvertent. We've all heard stories about employees clicking on malicious links and phishing emails, or sharing passwords or other security credentials to unauthorized personnel in tech support scams. Adding to the concern is that as financial technology tools and systems become more widespread and integrated into the mainstream of financial industry operations, credit unions will need to be prepared for additional potential cybersecurity risk. On balance, we expect fintech to be a tremendous benefit, but it is a reality that new tools are likely to present new vulnerabilities. The good news is that while the threats continue to grow and evolve, so does our ability to counter those threats, largely through a lot of the efforts that we've heard talked about today at the board table. Finally, open communication is critical. The NCUA board is considering a proposed rule requiring credit unions to report substantial cyber incidents within a reasonable period of time. Do note that such requirements are not intended to punish credit unions or create a regulatory or reporting burden, but rather to give us a better understanding of the frequency and severity of threats so that we can work with credit unions more effectively in developing a response. Unfortunately, cybersecurity isn't one of those areas where you can just set it and forget it. It's an ongoing commitment. Due to the nature of the threat, we all need to make cybersecurity a top priority to protect credit unions and the employees and the member owners. I'm going to take a brief moment and acknowledge one of the things that we at NCUA are doing. You've heard a very robust discussion today, but we talk about the need for cybersecurity professionals, where you all, our agency, I'm very proud to inform you all today, is working to develop a cybersecurity career development program. This was launched with Jackie Watkins through our high school scholars internship program. And the whole point of this, you all, is to make sure that we are developing a pipeline of talent who will have the appropriate credentials to do with cybersecurity. So the training is equipping the students with those opportunities, whether they be in high school or college, and it's accomplished, you all, by providing them with the requisite knowledge, training, and resources to pursue a career in cybersecurity. It's also offering them, you all, professional mentorship and also giving them guidance in resume writing and interview training. What are some of the career tracks that we can find for these up-and-coming cybersecurity professionals? Information assurance, incident responder, cybersecurity administrator, cybersecurity analyst, penetration tester, cybersecurity engineer, and forensic investigator. So I'd like for the industry to know that, yes, we're talking about issues, and we're going to need individuals with the credentials to help our credit unions and even our agency address them. So hats off to Jackie Watkins and our folks for, again, developing the cybersecurity career development training program. Also, I now am just going to conclude by asking one question, and that is, Ernie, you've talked about ICE and how it does align with ACIT. In fact, when I talk about the cybersecurity being the one thing that keeps me up at night, I also talk about automated cybersecurity examination toolkit. Will that really continue to exist alongside ICE? I know you tell me that it aligns. What will happen? Because I tell folks that it is one of the tools that they can use.
Yes, sir. This is Ernie. Great question. Love it because in getting away, it's taken about a year for me to correct the narrative in the environment when we were strictly talking about Intrex. People understood Intrex, and that's all I would hear everywhere I went was Intrex. So finally, that's done, and folks are saying ICE. It was purposeful and intentional that we understand that there is an assessment side that will continue. The assessment is always associated and on the backs of our credit unions with the ACET cybersecurity evaluation, cybersecurity preparedness assessment tool. What we have now with the ICE is that second key component, and that's the examination component, which we've finally been able to bring to fruition. So if you think assessment and then actually examination, those two will exist in the toolkit, so you have the familiarity and they're aligned across the essential elements of SCUP, Core, and Core Plus.
Great response, and thank you. And again, I'm just delighted about the tools and resources that our agency is making for our credit unions so they can really be prepared for cybersecurity attacks if they should happen. So thank you all. That concludes my time.
Thank you so much, Board Member Hood, and thank you all for your very informative briefing. I continue to be in awe of all that you're doing and developing and helping to mature not only our internal systems, but also the credit union system more broadly. So thank you.
Thank you.
Thank you.
The second item on our agenda today is a board briefing on the Central Liquidity Facility. Staff presenting is Anthony Capetta, Central Liquidity Facility President. Anthony, once you get settled, you may begin at any time.
Thank you. Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. I'm here today to provide an update on the Central Liquidity Facility. Effective liquidity and interest rate risk management are key components of a credit union's safety and soundness. This past year has witnessed a rapid rise in interest rates that has put increasing pressure on credit unions, and the prospect of even greater economic fluctuations in the coming year make access to sources of contingent liquidity like that from the Central Liquidity Facility especially important. Slide, please. Excuse me. The Central Liquidity Facility, CLF, or facility, was created by the National Credit Union Central Liquidity Facility Act. The facility is a mixed ownership government corporation which exists within the NCUA, and the CLF office manages the facility under the oversight of the NCUA board. The purpose of the CLF is to improve the general financial stability by providing member credit unions with the source of loans to meet their liquidity needs and thereby encourage savings, support consumer and mortgage lending, and provide basic financial resources to all segments of the economy. The CLF was created in 1979 because credit unions needed their own source of funds to meet the liquidity needs in the same way the Federal Reserve System's discount window provided access to loans for banks. Access to federal contingent liquidity sources has changed favorably over time. For example, credit unions who qualify may now borrow from the Federal Reserve discount window, but the CLF continues to be an important major backup source of liquidity for both federal and state chartered credit unions. Because the CLF is authorized to make loans to the National Credit Union Share Insurance Fund, state credit union share insurance corporations, guarantee credit unions, and guarantee associations, the CLF can also provide a vital source of funds to assist with any system-wide liquidity events that may occur. Slide, please. To become a regular member of the CLF, a consumer credit union joins the CLF directly and completes an application and subscribes to the CLF capital stock in the amount of 0.5% of its paid-in and unimpaired capital and surplus. Regular members of the CLF make loan requests directly to the facility. To become an agent member, a corporate credit union joins on behalf of their natural person credit unions and completes an application and purchases stock on behalf of those credit unions in the amount of 0.5% of their paid-in and unimpaired capital and surplus. Agent members serve as a conduit between the CLF and the natural person credit unions covered by them. In both cases, half of the required capital stock purchased is paid in and half is on call and maintained on the members' books in liquid assets. Detailed instructions for both membership types, including a calculator to assist with determining the number of shares to be purchased, can be found on the CLF page of ncua.gov. Slide, please. In October 2013, the NCUA board adopted a final rule on liquidity and contingency funding plans, Part 741.12 of the NCUA regulations, often referred to as the liquidity rule. NCUA adopted this rule to ensure all consumer credit unions conduct sound liquidity planning. The rule requires that credit unions with assets less than $50 million must maintain a basic written policy that provides a credit union board-approved framework for managing liquidity and a list of contingent liquidity sources that can be employed under adverse circumstances. For credit unions with assets of $50 million or more, they must also have a contingency funding plan that clearly sets out the strategies for addressing liquidity shortfalls in emergencies. Lastly, for large credit unions, and that is credit unions with assets of $250 million or more, they must establish access to at least one federal source of contingent liquidity, the Federal Reserve discount window and/or the central liquidity facility. Currently, 221 credit unions with assets of $250 million or more are regular members of the CLF. Next slide, please. There are three categories of liquidity sources that apply to liquidity planning. Each of these sources is relevant to the underlying safety and soundness of the credit union's liquidity management program. Essentially, these sources act as layers of liquidity protection and function similar to a series of financial firewalls. The first layer is on-balance sheet liquidity. Maintaining a balance sheet cushion of unencumbered, highly liquid assets is the first line of protection. It is essential for credit unions of all sizes to hold an adequate safeguard of cash and cash equivalents, such as short-term deposits and U.S. Treasury bills. This liquidity cushion assists in avoiding service disruptions and provides time to enter external funding arrangements if necessary. The second layer is access to market sources of funds and the ability to borrow from market counterparties. Credit unions build and develop borrowing relationships with corporate credit unions, a correspondent bank, a federal home loan bank, or with repurchase agreement counterparties, to name a few. A credit union's ability to borrow from market funding sources often requires unencumbered assets acceptable to those lenders, which can be readily pledged against their loans. The third layer is the contingent federal liquidity providers such as the discount window or the CLF. The discount window and the CLF exist to provide backup liquidity in circumstances where on-balance sheet liquidity and market funding sources prove inadequate. While sparingly used, the CLF has proven to be a dependable source of liquidity in times of crises and unexpected events. Like other funding sources, the discount window and the CLF are both collateral-based lending facilities. All loans must be fully secured with a first priority security interest. Next slide, please. By statute, the liquidity needs for the CLF advances are appropriate. Liquidity needs for the CLF advances are appropriate and limited to short-term adjustment credits, and these are available to assist in meeting temporary requirements for funds or to cushion more persistent outflow of funds pending an orderly readjustment of credit union assets and liabilities. Seasonal credits available for longer periods to assist in meeting seasonal needs for funds arising from a combination of expected patterns of movement in share and deposit accounts and loans. And protracted adjustment credits available in the event of unusual and emergency circumstances of a longer-term nature resulting from national, regional, or local difficulties. Short-term adjustment credits generally are available for maturity periods of up to 90 days. Seasonal credits are available for periods up to 270 days and are generally restricted to institutions that demonstrate a pattern of recurring need. And protracted adjustment credit advances are available for periods in excess of 270 days, but are only made when exceptional circumstances are adversely affecting an individual institution. Next slide, please. Historically, CLF advances have been intended only to help maintain financial stability for credit unions that were experiencing liquidity difficulties or expected to experience liquidity difficulties in the immediate future. In most circumstances, CLF will make advances when the borrower's primary sources of liquidity are inadequate, impracticable, or otherwise unavailable at the time of need. The CLF is prohibited by statute from making an advance, the intent of which is to expand a credit union portfolio. What then are some of the examples for an appropriate CLF advance requests. Slide, please. The appropriateness of granting a CLF advance depends on the circumstances of the credit union at the time of the liquidity need. Appropriate circumstances for seeking CLF advances may include, but are not limited to, borrowing to meet an unexpected loss in shares or non-member funds, borrowing to address an unexpected surge of credit demands within the credit union's membership, and borrowing to meet liquidity needs due to forces beyond the immediate control of the credit union, such as an internal operating problem or a natural disaster. Slide, please. However, borrowing from the CLF is not appropriate to take advantage of a differential rate between the rate of a CLF advance and the rate of alternative sources of funds, also known as spread arbitrage, borrowing to substitute CLF credit for normal, short-term, interest-sensitive shares such as certificates or money market shares, or borrowing to support a planned increase in loans or investment holdings or new loan product offerings. Slide, please. Upon receiving a request for liquidity advances, the CLF will underwrite for creditworthiness and liquidity needs. We will confer with supervisory authorities on borrow condition and assist in resolving any potential intercreditor conflicts. Our advances will be at the interest rate, the higher of the discount window's primary credit rate, commonly known as the discount rate, or the Federal Financing Bank's rate with same tenor. The Federal Financing Bank is a government corporation under the United States Treasury that provides financing to federal agencies like the CLF. The CLF will also work with borrowers to ensure that the primary liquidity access can be resumed at the maturity of the loan, or transition the borrower to supervisory authorities if warranted. Slide, please. Presented here are the financial highlights of the CLF. As a reminder for stakeholders, the monthly financial statements are posted on the CLF page of the NCUA.gov. As of September 30th, 2022, the CLF's total assets of $1.2 billion have produced a year-to-date net income of $1.1 million. Returned earnings are $40.5 million, and they provide a base for borrowing, support risks inherent in operations, including interest rate risk and credit risk, and support the cost of operations. Third quarter 2022 dividend rate was 2.24%, and the third quarter total membership, that is both regular and agent members, was 3,991. That membership provided the CLF borrowing authority of $29.3 billion. Next slide, please. The 3,991 total members of the CLF are divided between 350 regular members and 3,641 agent members. Membership trends remain favorable, with net losses to regular member rolls due to merges and withdrawals are offset by new membership and conversions from agents to regular membership. 82% of all federally insured natural person credit unions currently have access to emergency contingent liquidity through the CLF advances. Next slide, please. The CLF is financially self-supporting and funded exclusively through earnings on investments. The chart shown here depicts operating expenses and total revenue for the past 11 quarters. The operating expense ratio, also shown, illustrates the relatively low cost of operations compared to net operating income. Note that CLF advances do not increase total revenue, as all loans by the CLF reflect a loan rate based on facility costs. Increases in revenue are directly related to earnings on investments, which are a function of market interest rates. An increase in the number of CLF advances will not decrease the operating ratio. Next slide, please. By statute, the CLF may only invest in obligations of the United States or any agency thereof, make deposits in federally insured financial institutions, and make investments in shares or deposits of credit unions. Currently, the CLF investment portfolio is invested in non-callable U.S. Treasuries, overnights, bills, notes, and floating rate notes and bonds. Next slide, please. The CLF investments are governed by policy. This policy requires that the objectives of the investment activity are to provide for member credit union liquidity needs by holding sufficient funds in overnight accounts to meet unexpected loan demand, fund requested liquidity reserve clearing account or membership withdrawals, and to maintain a balance of funds in authorized investments whose portfolio mix is a function of the facility's investment strategy that considers liquidity expectations, projected credit union needs, credit risk, and the current interest rate environment, as well as market expectations. Next slide, please. This chart depicts the composition of the CLF investment portfolio as of September 30th, 2022. To meet investment objectives, the majority of the investment portfolio is positioned in overnights and short-duration assets, including United States Treasury floating rate notes. The portfolio is well positioned to perform in the current rising interest rate environment and meet any anticipated demands for facility advances, membership withdrawals, and operating expenses. Slide, please. Capital stakeholders receive a quarterly dividend on their paid-in portion of their contributed capital. The dividend rate is administered as an ability-to-pay commitment. The CLF pays dividends after covering expenses and meeting retained earnings objectives. The CLF has always paid a dividend, and its policy is to pay a dividend that's commensurate with the Federal Reserve's excess balance account rate. Slide, please. The CLF has two primary sources of funds that it can use to fund advances to its members, and the limitations exist on the amount of funds available from each source. To balance these limitations against the need to expeditiously respond to urgent and high-priority requests, the CLF generally maintains a minimum balance in its operating account while funding each new request for funds first with advances from the Federal Financing Bank. When acting on behalf of the CLF, the NCUA board has the power to borrow up to 12 times multiple of its subscribed capital and surplus of the facility. As of September 2022, the CLF's borrowing authority remains at a robust $29.3 billion. Next slide, please. The CLF continually improves to better serve its members. Operational modernization efforts to provide a do-it-yourself share calculator for interested members, digitized forms, and robust tools to support facility loan officers are constantly being improved and updated. Members will soon be able to obtain all of their quarterly and annual statements through an online portal located on ncua.gov. Revisions to the dividend policy have also been made to ensure that the agent members receive their dividends as of the date they leave the facility. And collateral policies have been further refined to accommodate the types of collateral likely to be pledged to the CLF. NCUA also recently announced a full-time CLF Vice President job opening to further improve operations and support membership. Next slide, please. Looking forward, we will monitor the liquidity conditions at the credit unions and credit union system levels, continue our efforts to support and strengthen CLF membership, explore avenues to increase access to emergency liquidity, work with the corporate credit unions in partnership with consumer credit unions to exercise CLF borrowing agreements, improve stakeholder outreach and communication, redeem the corporate agent memberships if not extended by law, and provide federal contingent liquidity if and when needed. That concludes my briefing, and I'd be happy to answer any questions you may have.
Thank you, Anthony, for your informative briefing on the Central Liquidity Facility, or CLF for short. Since becoming the CLF president, you and your team have worked hard to bolster and improve the facility's processes, operations, and structures. Thank you for your diligent efforts. I think they were long overdue.
Thank you.
And Board Member Hood, thank you for being such a strong advocate for a separate CLF office within the NCUA with a full dedicated president whose only job is to focus on liquidity issues. Thank you to Vice Chairman Hoffman for your continued support of these improvements in the CLF's operations. With more than $29 billion in borrowing capacity, $1.2 billion in total assets, and nearly 4,000 regular and agent members, the CLF is a vital source of emergency liquidity within the credit union system. However, the pending expiration of the temporary CLF enhancements authorized by Congress at the start of the COVID-19 pandemic remains a very real concern. We already know that several credit unions are experiencing liquidity issues, and some of these credit unions have more than $1 billion in assets. And with ongoing inflationary pressures, likely continued increases in interest rates, there is a potential for strong headwinds slowing the economy and increasing stress on households and financial institutions. Those headwinds could also soon result in even more credit unions encountering liquidity issues. So the CLF must stay alert and ready to support the credit union system and the Share Insurance Fund. For the CLF to work best, we need a flexible member-agent option. By permitting corporate credit unions to become agent members for groups of credit unions within their membership, rather than requiring them to join for all of their membership, the CLF becomes a much more affordable and attractive option for corporate credit unions to participate in. Without agent membership, credit unions with less than $250 million in assets will be much less likely to have access to a federal liquidity backstop when they need it. And without legislation to extend the temporary CLF enhancement provisions, there will be a $9.7 billion reduction in reserve liquidity for the credit union system at the end of 2022. Likewise, the 3,648 credit unions with less than $250 million in assets that now have access to the CLF through their corporate credit unions will also lose a liquidity lifeline. These credit unions include most of our nation's 509 minority depository institutions. We know from the painful lessons of the financial crisis more than a decade ago how quickly liquidity can dry up during periods of economic and financial stress. You, of all people, certainly know that as well, Mr. Vice Chairman. While we are grateful to Congress for allowing the CLF enhancements for the last few years, there's a real need to keep in place this provision. That authority will allow us to provide emergency liquidity quickly when needed. Now, let me turn to a few questions. Anthony, how can the CLF best achieve its full potential?
Thank you, Chairman, for that question. I too, like you, believe that the CLF can best achieve its potential in a couple ways. The first is the permanent changes to Title III of the Federal Credit Union Act, similar to the temporary changes made by in the CARES Act.
Sure.
In this way, the CLF would be better equipped to provide contingent liquidity needs to a greater number of credit unions and the system, if necessary. Second is through growing the CLF membership roles. In this way, the CLF would be capable of providing more emergency liquidity to a greater number of credit unions and the credit union system. That concludes my answer.
And how are you going about doing that? I mean, obviously you can't do the Congress piece, but you can do the piece of speaking with and talking to credit unions. What are your plans there?
So we have explored several ways to outreach and work with the credit unions. As I had mentioned in membership, we have many that are currently agent members
Sure.
of the facility, and to discuss and with them the benefits of becoming a regular member. That is one of the ways. Another way is to engage the regions and the SSAs for them, because they're the direct link with the credit unions, more directly with me. And I have discussed with many of them how the CLF can support the liquidity plans at those credit unions.
I'm pleased to hear that. I think that CLF is one of those little secrets not a lot of people know about.
Yeah. I also, too, I am part of and participate in the corporate credit union meetings at times, as well as liquidity webinars and things like that.
Yeah. Anthony, I talked about that we're seeing growing signs of interest rate risk and liquidity risk within the system. Would you highlight some of the trends you're seeing and what you have top of mind as the CLF president?
Yes, thank you for that question. Anecdotally, I too am hearing that credit unions throughout the system of all asset sizes are facing liquidity challenges. and have, for example, turned to borrowings, which are potentially causing a rapid increase in credit unions' cost of funds. The most recent call report data of credit union borrowings, and this is as measured by the ratio of borrowings to total share and net worth, has increased from 2.2% to 3.2% year over year, and that seems to support that view. Furthermore, the most recent call report data also indicates that credit union liquidity as measured by the cash and short-term investment to total assets ratio has decreased by 5.5% year over year, from 18.5 to 13%. This relatively low and declining ratio supports the premise that credit unions are also potentially finding it more difficult meeting their current obligations.
And Anthony, would it be possible for the CLF to sort of build, I mean, these are some really good statistics, and I assume as some of these numbers go up, you become more worried, or down, depending on what the metric is, you become more worried. Is there any effort within the CLF to build out a communications plan for, I mean, you need that liquidity in place before the pipes freeze up. You don't want to be, to borrow another house analogy, you don't want to be fixing your roof during the middle of a storm. Are you, in the long term, going to be moving down that road?
Yeah, certainly in the long term, in addition to the stuff that, the day-to-day interactions, but to reach a greater audience, if you will, of potential members, we're going to do just that.
Okay. My final question is about the pending expiration of the agent member authority amendments adopted by Congress at the start of the COVID-19 pandemic. Would you discuss the consequences of that authority expiring?
As you had mentioned, when that authority expires and we need to redeem the agent memberships on December 31st of 2022, as a consequence of that expiration, there'll be 3,641 credit unions who currently have access to the CLF through their agents. They'll no longer be able to request liquidity through them from the CLF. Additionally, because that capital will be redeemed, the shares will be redeemed and the capital will flow out, the CLS borrowing authority from all sources will decrease by approximately $9.7 billion.
Yeah, and that's about, it's not quite a third, but it's close to a third.
Yes.
That's telling. First of all, thank you for laying out those consequences, and thank you for working on that sort of broader, future communications plan. I know you've got limited resources, and once you get a vice president in place, you'll be able to work on those more. One thing else that I would encourage you to do, I know that when we have major natural disasters, we often go out with a reminder to credit unions that they can apply, low-income credit unions can apply for emergency grants through the Community Development Revolving Loan Fund. Certainly not every major disaster, creates the need for a liquidity event, but keeping an eye out for those opportunities to remind credit unions that the CLF there, I think, is really important. And just one last point of emphasis, we as a board are absolutely united. We wrote together to Congress asking for the CLF extension. We're going to stay steadfast in those efforts. That concludes my remarks. Vice Chairman Hoffman.
Thank you, Mr. Chairman, and thank you, Mr. Capetta. If you don't know, what Chairman Harper is referring to about liquidity, I was at Lehman Brothers when it all fell apart. I had a front row of the front row. I was a repo trader, so funding the entity, and you see the liquidity slowly dry up, and it's definitely a truism that regardless of your balance sheet, if everybody thinks you have a credit problem, then you have a credit problem. And I remember, anyway, that was an interesting time to be alive. So thank you to the both of you, Rodney and Todd, for elevating this issue by requesting this as an annual update. The CLF is the only practical source of emergency liquidity for over 3,600 credit unions under 250 million in assets. That's 3,600 of about 4,900 total in the United States. It's been 40 years since we've seen inflation at the levels they are today. Interest rate, risk, and liquidity are therefore a growing challenge. Although the credit union movement has a variety of tools to manage these challenges, including the derivative rule that we passed and our updated supervisory guidance on interest rate risk, credit unions under 250 million are especially vulnerable. They are limited in their ability to manage their interest rate risk using derivatives, even in the simplest form allowed by NCUA. More to the point, these credit unions are so limited in resources that a direct relationship with the CLF is impractical. The CARES Act in 2020 solved that problem by authorizing a corporate credit union to join the CLF on behalf of a subset of its members. However, that authorization expires New Year's Eve this year. Small credit unions, especially those 3,600, face the real prospect of losing the CLF as their emergency liquidity source. In addition, we expect an immediate reduction of $9.7 billion in reserve liquidity for the credit union system as the corporates withdraw their funds. That's a $9.7 billion buffer between credit unions and the American taxpayer. The current interest rate environment makes liquidity event a real possibility. Without agent sponsorship to the CLF, my fellow board members and I are deeply concerned about the consequences for the credit union movement. That concludes my remarks. I just have one question. Anthony, let's just walk through this. December 31 of this year. What has to happen between now and then to stop 3,600 credit unions from losing access to the liquidity facility?
Congress would need to pass, and the president sign into law, either the temporary or permanent changes to Title III of the Federal Credit Union Act, similar to those that were enacted during the COVID-19 pandemic that were put into the CARES Act. Specifically, they need to modify the language to Title III that grants the NCUA board the authority to approve agent membership groups that cover a subset of their members.
So how is life different? You're a little credit union out there. What you just said, that happens or it doesn't happen? I'm a little credit union out there, 40 million in assets, something like that. How is my life different? What practically can change whether Congress and the president act in the manner you said, or they don't? What's the actual difference?
Well, a ready source to emergency liquidity from the CLF. And what they could do is, of course, and we encourage this, they could become members of the CLF so that replaces that. And in that case, they would have to put up the collateral as opposed to the corporates doing it. Or they would have to access other sources of market funding for liquidity.
All right. So the bottom line is they have money that has to go out. You have to pay to somebody. Somebody withdraws money, you have a bill to pay. They're solvent from a balance sheet sense, but they don't have the cash at that moment, right? And then if you don't have this source of liquidity, that could cause what we call a liquidity event, right? And what would NCUA have to do in that scenario?
Well, if the CLF was unable to deliver some kind of liquidity support, they would, I imagine, become an issue and pursued through supervisory authorities and look for 208 assistance from the Share Insurance Fund.
All right. Thank you, Mr. Chairman. That concludes my remarks.
Thank you, Vice Chairman. Board Member Hood.
Thank you, Mr. Chairman. And also, I want to thank you for honoring my request about holding today's briefing on the CLF. So I really do appreciate it. Given that
It was a very good idea.
Oh, thank you. Given that we as NCUA board members also serve on the Central Liquidity Facilities Board, I believe it's important for today's briefing for a number of reasons, but especially as we are beginning to see liquidity pressures at some of our credit unions, and you evidenced this in a lot of your comments already, Anthony. And also, Anthony, thank you not only for your presentation, but also for taking the opportunity to serve as the president and how you've already hit the ground running.
Thank you.
With that being said, I know you talked a little bit about the current state of liquidity in the credit union system. Could you expand a little more? You talked about the most recent call report data. Any other insight you can share?
Well, I could say that I can report that no advance requests have come to the CLF, and no members have contacted us, seeking such. And that kind of indicates that member credit unions, at least the CLF member credit unions, are adequately managing their balance sheet liquidity and their alternative market funding sources. I did discuss some of the share ratios as we see what's going on, and those are really my insight to liquidity conditions at the credit union level.
Very well. I'm just listening to the sirens as we talk about risk, and I'm like, wow, is that a warning sign? Could you talk a little bit about, Anthony, how credit unions have changed their balance sheets in response to rising rates from the situation just 1 year ago?
Well, credit union borrowings, and this is as measured by the ratio of borrowings to total shares and net worth, have increased from 3.2 to 2.2 in December 2021, and 2.1% from a year ago.
Great. And then what about the borrowings? What change have we seen there?
Shares, excuse me, local and total assets, or rather loans and total assets have grown year over year. However, loan growth has exceeded share growth. As a result, credit unions have seen a shift in their balance sheets, with the loan to shares ratio increasing from 74.8% to 74.8% from 69.8% a year ago.
Very well, thank you. And I'll just continue. The Central Liquidity Facility is a source of liquidity that is sorely needed. And I must say, you all, that it's not a question of if there will be another financial crisis, but when there will be another financial crisis. Anthony, what is indeed the best way for credit unions to use the CLF before it's, what I would say, too late?
As I discussed in my presentation, it would be understanding, the constraints we operate under per the statute, and I tried to present, the conditions that meet the, that first they would have to be creditworthy, and then secondly they'd have to have this liquidity need, and we could advance under that liquidity need per the statute. Those examples that I provided for when borrowing is appropriate, it would certainly be times when those credit unions member credit unions could come to the CLF for advances.
Very well, very well. Well, during the CARES Act several years ago, Congress temporarily enhanced the CLF's authorities. Those authorities were extended by Congress in the Consolidated Appropriations Act 2021 for another year. These changes were critical because it temporarily relaxed the requirements on agent membership, making membership more economically feasible for corporate credit unions, which ensured that more natural person credit unions had access to the CLF. In fact, it's my understanding that that was the largest membership we've had in quite some time, of over 3,600 members.
Since the days of U.S. Central, when they were the agent group representative.
Very well, and that was especially critical because after the involuntary liquidation of U.S. Central in 2010, that was why it was really important that we have them. Well, prior to U.S. Central's involuntary liquidation, most natural person credit unions effectively had access to the CLF without the expense of a CLF subscription through U.S. Central. Since U.S. Central no longer exists, extending the agent membership change in the statute is critical. At Chairman Harper's request, I have reached out to leaders on Capitol Hill to encourage them to extend this provision in a sign and a show of bipartisan support. As I've said before, we should prepare for the worst and hope for the best. One of the best ways for the NCUA to prepare for the worst and hope for the best is to have a very robust central liquidity facility. One of the reasons I agree with my board colleagues to have the CLF as a separate office is because we need to revamp the system. And I was pleased to see what you're doing to revamp the system through the slide that you mentioned, the enhancements that you're making. And I hope that as you continue to do that, you will continue to sit down with the corporate credit unions and the natural person credit unions to create a cooperative facility that reflects the realities of today under our agency's existing powers. Anthony, what are you doing to create awareness of the CLF among credit unions, especially as the state of the liquidity in the system is changing? I know you mentioned outreach in one of the slides. Are there any things of convenings or any things like that that are on the horizon?
Yes, so as I had mentioned earlier, several of the ways we are conducting our outreach is to talk to current agent members to see and have them understand why maybe subscription to CLF as a regular member would be beneficial to them. I am constantly speaking with one or more of the corporates to have them help understand how they could support us as our fiduciary in their role as correspondents, as well as currently agent members. And so those have been my kind of the lead ways I've been conducting the outreach.
Oh, very well. And then I'm just going to conclude with a few quick questions. Of the CLF members, how many are less than 50 million? And then between 50 and 250 million and over 250 million in assets?
Yes, so for regular members, less than $50 million in assets, there's 20. For those that are between 50 and 250 million, there's 109. And as mentioned in the brief, those greater than 250 million are the 221.
And then one area of concern is when I think of the credit unions below 250 million that have agent membership via corporates, how many credit unions in this category are not members of a corporate and therefore unable to borrow via this option?
So all consumer credit unions that are part of an agent members group, regardless if they're a member of the corporate or not, are able to borrow from the CLF. The corporate's agent membership provides them access to the CLF for the group that they provided the capital subscription for and conducted, the membership documents and such. No members, and it is clear to mention this, no members, CLF members are required to be a member of corporate to borrow. Even if they're a regular member, they do not have to be a corporate member, but a corporate is required on our part because they function as our fiduciary. So a regular member who is not a member of a corporate does have to identify a corporate that they will work with for them to do our various actions, collateral safekeeping, perfecting the first security interest in a collateral posted and things like that. And also assistance with helping with our membership documents, borrowing documents. Furthermore, natural person credit unions incur no cost to be included in that agent group, and they have no obligation to borrow from the CLF, and they can even decline to be included in that group.
Well, that's good to know. I know we often talk about the Federal Reserve Bank and its discount window access that we like for the credit unions to have access to. We'd be remiss if we didn't talk about the Federal Home Loan Bank. I'm a huge supporter of that system and what it does, not only for affordable housing, but also what it does to help with liquidity. Of those credit unions that are over 250 million in assets, could you give me a number, an idea of how many have accounts at the Federal Reserve and how many have accounts with the Federal Home Loan Bank?
Yeah, so of the CLF members with 250 million assets or more, there's 143 that also have an account with the Federal Reserve Bank. And also 262 CLF members are Federal Home Loan Bank members, and their lines of credits total approximately $52.5 billion.
Very well, thank you. And Anthony, I know on one of the slides you also mentioned when you were talking about enhancements, you're going to look at the dividend enhancement piece and a lot of modernization efforts. At what time did the CLF pay its entire net income as a dividend to the credit union shareholders, and when did this change?
Yes, thank you for that question. They did. In an action dated in May 16, 1996, the NCUA board approved a change to the CLF's reserving policy so that no additional reserves would be added. Excuse me. Indefinitely, provided that the CLF continued to periodically reevaluate its reserve needs. Since 1995, that the CLF had not increased its retained earnings and instead elected to pay out earnings, all earnings in excess of its expenses. But in an action dated September 29, 2009, the NCUA board approved the resumption of the building of capital through ongoing quarterly retention of earnings. And this action was in response to the increases in expenses and to maintain appropriate contingency reserves that were a result of the lesson learned of what was going on during the global financial crisis of 2007, 8, and 9.
Great, thank you, Anthony. And I'll conclude with this one question, and that is, who is responsible for investments in the CLF, and is there a written investment policy?
Okay, thank you for that question. So ultimately, the NCUA board is responsible for the investments. However, under delegation of authority, CLF3, the president, me, of the CLF has the authority to invest the facilities funds in accordance with the Federal Credit Union Act, which I discussed during the presentation, and with concurrence of an investment committee and the NCUA board policy. So with the short duration portfolio, like I showed, this occurs almost daily where we're investing funds. The CLF Investment Committee consists of the Director of the Office of Examination and Insurance, the President, the CLF President, and an E&I Senior Capital Market Specialist. And we meet at least quarterly and when the CIF Investment Committee meets. There are both board-approved written investment policies, and there is a written investment strategy.
Very well, thank you, and thank you for your leadership. Again, we certainly as a board want to continue to give you the resources you need to succeed and build a very robust CLF group, especially now that it's a separate entity. So we certainly look forward to hearing about the VP search that you're going to be looking to hire soon. And I look forward to some of the other enhancements that you referenced today, and maybe we can bring Anthony back at some point in the future.
Thank you.
Provided you want to come back. I don't know.
Sir.
Thank you all. But that does conclude my remarks. And
No,
thank you.
Absolutely, we want him back at the table. And again, thank you for your leadership. Anthony, there's one question that occurred to me as Board Member Hood was speaking. It takes some time to apply to become a CLF member. Is it a week? Is it 2 weeks? Is it a month?
So since the COVID-19 crisis and our digitizing forms, improving communications, having more access to come in through a centralized CLF mailbox, and a centralized phone number, et cetera, it's actually a pretty rapid membership process. The biggest, or I should say that the part that slows it down the most is, identifying and agreeing on the amount of capital stock that needs to be purchased. And to that end, we include and have out there for potential members to use the capital stock estimator. So they work with the CLF team, and then once their board, because that is required to their board action, and they return the credit and reporting agreement to us, officially signed by and approved by the board, they can become members. But it is, it varies from credit union and size, of course, and also their ability to understand what they need to do, which of course we and others help out with that. It varies from a week to a couple weeks.
Okay.
But
and sometimes you don't have that week when a liquidity.
Yes, and I was just about to mention that. And in terms of, to your earlier question, the benefits of being a CLF member is not only that you have access to the liquidity, but it's there on demand, if you will. There's no reason to, or it's not necessary to go through that process,
Right.
Which may take time when there's time is precious.
Sure. No, absolutely. Anthony, thank you so much for that briefing
Thank you.
on the Central Liquidity Facility.
Thank you all.
And we look forward to the next time you join us here at the board table.
Okay.
The third and final item on our agenda today is the NCUA's 2022 Risk Appetite Statement. Staff presenting are Rendell Jones, Deputy Executive Director, and Jim Holm, Supervisory Budget Analyst, Office of the Chief Financial Officer. Rendell and Jim, you're now recognized.
Good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. I'm here today with Jim Holm, Director of Strategy and Budget Division in the Office of the Chief Financial Officer, to present the proposed NCUA Risk Appetite Statement and recommend the Board approve it. The NCUA, like other organizations, is subject to a variety of risks that relate to its objectives, strategies, operations, reputation, and environment. Through the NCUA's Enterprise Risk Management Program, the agency proactively manages risks that could hamper its efforts to achieve its mission while identifying other risks that may create opportunities for the NCUA to improve its effectiveness in delivering results. The NCUA's ERM program is guided by the Office of Management and Budget Circular A123. The circular provides guidance about the design and implementation of federal ERM capabilities and practices and encourages agencies to establish an enterprise risk appetite. The circular is based on the Committee of Sponsoring Organizations of the Treadway Commission, or COSO, ERM framework. The NCUA's ERM program is overseen by an Enterprise Risk Management Council, the ERMC, which was formally established by a charter signed by the Executive Director in 2015. Since that time, the ERMC is focused on building foundational elements of the NCUA's ERM program identifying, assessing, and prioritizing enterprise-level risks, and developing risk response plans for those risks. The ERMC's membership includes several of the agency's senior executives, including Matt Baloris, Director of the Office of Consumer Financial Protection, Rob Foster, the Chief Information Officer, Sherry Freed, Regional Director for the Western Region, Kelly Gibbs, Director of the Office of Continuity and Security Management, Amber Gravius, the Director of the Office of Business Innovation, Kelly Lay, the Director of the Office of Examination and Insurance, Andy Leventis, the Chief Economist, and Eugene Sheed, the Chief Financial Officer. As NCUA's Deputy Executive Director, I serve as the Chair of the ERMC. Our work is supported by staff in the Office of the Chief Financial Officer, including Lindsay Courage, Jim Holm, who's here with me at the table, and Melissa Loudon. The members of the ERMC have dedicated significant time and effort since the Council was chartered to develop NCUA's Enterprise Risk Management Program, and we will continue to work to improve and mature the program. By focusing on enterprise risks, the ERMC works to minimize the impact of potential adverse events that could hinder the agency's ability to accomplish its strategic goals and objectives. Further, the ERMC seeks to establish a risk-aware culture and appropriate risk management processes throughout NCUA. An important part of a successful ERM program is a comprehensive enterprise risk appetite statement. Our risk appetite statements are management tools that provide guidance from the board to managers and staff about the amount of risk NCUA is willing to undertake in pursuit of its objectives. The Office of Management and Budget guidance about enterprise risk management that I mentioned earlier notes that, quote, the concept of risk appetite is key to achieving effective ERM, end quote. While the Federal Chief Financial Officers Council ERM playbook explains that risk appetite statements, quote, help agencies make risk-informed decisions with regard to the allocation of resources, management controls, and potential consequences or impacts to other parts of the organization, and can reduce surprises and unexpected losses, end quote. Finally, it's important to know that NCUA's Enterprise Risk Management Program and its risk appetite statements will change over time as the nature of risks evolve on changing conditions internally and externally to the agency. Now let me ask Jim to discuss additional details about how we develop the risk appetite statement.
Thank you, Rendell, and good morning, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. The ERMC developed the risk appetite statement before you today through careful consideration and evaluation of the risks the agency faces, and focused on achieving several programmatic goals, including communicating guidelines about the level of risk the NCUA is willing to accept in pursuit of its mission and goals, promoting consistency and understanding, measuring and managing risk across the enterprise, informing agency responses to risks and decision-making to balance limited time and resources, and driving a more risk-aware culture at the agency. In March 2022, the NCUA board approved the agency's overarching risk management philosophy as part of the 2022 to 2026 strategic plan. The risk management statement in the strategic plan states, quote, NCUA is vigilant and has an overall judicious risk appetite. NCUA's primary goal is to ensure the safety and soundness of the credit union system, and the agency recognizes it is not desirable or practical to avoid all risk. Acceptance of some risk is often necessary to foster innovation and agility. This risk appetite will guide NCUA's actions to achieve its strategic objectives in support of our mission, end quote. Guided by this risk management philosophy, the ERMC worked to develop a more detailed risk appetite statement for the board's consideration. The council reviewed working papers used to write the current strategic plan, benchmarked risk appetite statements from other federal agencies, discussed risk categories and associated agency activities, and developed consensus views about risk appetite ratings for each activity. The proposed risk appetite statement is organized around 8 risk categories. These risk categories, sometimes called a risk taxonomy, enable the NCUA to identify and group risks consistent with its business processes. Risk categories also facilitate the understanding, communication, and management of risks throughout the agency. The 8 risk categories recommended by the ERMC are 1. Technology and information management risks, 2, supervision risk, 3, human capital risk, 4, legal and regulatory risk, 5, operational risk, 6, governance and strategic risk, 7, financial management risk, and 8, external risk. As part of its work on the risk appetite, the ERMC established definitions for each risk category, which are all included in the risk appetite statement before you. The Council also identified common agency activities aligned to each risk category and assigned risk appetites for each of those activities. To describe the different levels of risk appetite, the ERMC set up a 3-tier scale: tolerant, moderate, and averse, and I'll read those definitions now. Activities for which the ERMC recommends a tolerant risk appetite indicate when the agency is willing to accept significant risks when pursuing its strategic objectives. Activities for which the ERMC recommends a moderate risk appetite indicate when the agency is willing to accept medium levels of risk related to accomplishing its strategic objectives. And activities for which the ERMC recommends an averse risk appetite indicate when the agency is willing to accept little to no risk to achieve its strategic objectives. The risk appetite statement before you today assigns either a moderate or an averse risk appetite to all of the identified activities. There are no activities in the statement for which the ERMC recommended a tolerant risk appetite. As Rendell mentioned in his remarks, the ERMC intends this risk appetite statement to be a foundational document for enterprise risk management at the NCUA. In combination with the strategic plan, the risk appetite statement provides additional information for NCUA management, staff, and stakeholders about the agency's approach to achieving our goals and objectives. By asking for board approval, the ERMC expects the risk appetite statement will provide helpful guidance to all NCUA employees to make better informed programmatic, resource, and operational decisions. This concludes our presentation this morning. Thank you very much for the time today, and we're happy to answer any questions that you may have.
Thank you, Jim. Thank you, Rendell, for your presentation on the work of the NCUA's Enterprise Risk Management Council and the agency's risk appetite statement. I appreciate all of your hard work, and I will support approving this statement. I'd also like to thank Board Member Hood for encouraging the NCUA to take a more holistic approach to our enterprise risk management program. Your insight and leadership contributed greatly to the statement we're considering today. Moreover, the modifications suggested by Board Member Hoffman in the final document ensure that we will appropriately permit innovation to continue to occur within the credit union system. As noted earlier, the NCUA uses an enterprise risk management program to evaluate the various risk factors affecting the agency's performance relative to its mission, vision, and strategic goals. These factors and risks include both internal considerations, such as the agency's internal control framework, and external ones, like the evolution of the credit union system and the financial services marketplace. The enterprise risk appetite statement presented today is part of NCUA's overall management approach, and I'm especially pleased that we will have an averse risk appetite when addressing identified safety and soundness issues at credit unions. This means we will be risk-focused and ready to act expeditiously if needed when we identify problems. I also appreciate through the statement that we will remain focused on ensuring compliance with consumer financial protection laws and regulations at credit unions. Effective enterprise risk management and a well-articulated risk appetite are solid management practices for federal agencies and credit unions alike. A sound statement creates an understanding needed to achieve organizational objectives. Further, the NCUA's Enterprise Risk Management Program models the behaviors that we expect out of credit unions. So I encourage all credit unions to take a fresh look at their existing risk appetite statements or to begin the process of adopting a risk appetite statement. Assess the potential risks that your institutions face. Implement processes and structures to manage those risks appropriately and ensure that your credit union can adapt to the changing marketplace. Rendell, Jen, I just have two questions. The first one is, what are the next steps that the NCUA board will take? I should say, after the NCUA board approves this, what are the next steps that we will take with respect to this risk appetite?
Thank you, Chairman Harper. I'll take that. So the first is we're going to communicate the risk appetite statement to staff to ensure that they are aware of it in detail. The second, which is also very important, is with the Enterprise Risk Management Council, we will work to designate risk leads or people who are responsible for ensuring that we are looking at and evaluating these risks on periodic bases, depending on the nature of those evolving risks. And so to hold ourselves accountable to the decisions that the board will have made in this. And the final thing is we will also consider, as time goes on, how we update the risks as the nature of risks that the agency faces changes.
And I appreciate that. And Rendell, if I could ask, one thing that I hope that you do when we appoint these risk leads and lead them, that we make sure that they stay focused and not get siloed, not just think of it solely from one specific area, that they make sure that they cross-pollinate and talk to different offices and aspects. My second and final question is, how has the agency's previous enterprise risk management program guided the agency's actions before?
Sure. So since 2015, we have, as part of the council, looked at a number of enterprise risks and done assessments to determine whether or not the responses, the risk responses we call them, are appropriate and commensurate with the level of risk that, at least as staff, we thought we were willing to take on. So we've looked at cybersecurity, both internally and externally facing. We've looked at agency controls. We have one ongoing that was discussed at a board meeting earlier this year related to large credit union supervision program. And we also looked at concentration risk. And so that was, I think, 2018. And as part of our review, we determined that additional controls needed to be in place on the review of credit unions with significant concentrations. And then the following year, we had a recommendation from the Office of the Inspector General that was related to the same thing. And as a result of the work and in response to the Inspector General, we made changes to the examination program related to credit unions with significant concentration.
No, I think we learned an important lesson during the taxi medallion crisis about concentration limits and the need to make sure that we're managing things appropriately. Vice Chairman Hopman.
Thank you, Mr. Chairman. Thank you to you both for being here today. In the interest of time, I'm going to jump ahead here. I'm supposed to host a sort of back to work lunch downstairs, and standing between somebody and free food is a terrible place to be. I want to thank my board members for putting in some statements that I think the view of risk, and this is very hard for a government agency, is the risk of not innovating and the risk of us thinking that we are credit union's mom or dad and trying to tell them what they should or should not do in these cases. That's a recipe for disaster. We know that innovation is going to have problems. It always has. There were 0 plane crashes before we had planes. There will be problems. We don't even have to speculate with new technology. I talk about blockchain and crypto a lot. Guaranteed there's going to be problems. Guaranteed there's going to be vendors people get in with that don't work out and they wish they hadn't. Guaranteed there's going to be projects that the juice isn't worth the squeeze. They spend too much money and don't earn enough from it, and the board's going to regret approving it. Guarantee you that's going to happen. But otherwise, we're going to get hit by a meteor, and this entire industry is going to get wiped out if they don't innovate. Credit unions have innovated for decades. Here are the statements that I made sure to have in there. Encourage consistency in understanding, measuring, and managing risk across the enterprise while fostering credit union system innovation and growth. Also, acceptance of some risk is often necessary to foster innovation and agility. Okay? Ensuring credit unions manage their risk and maintain their ability to evolve and compete effectively through innovation. Implementation of policies and regulations to address emerging and innovative products and technologies that foster credit union innovation system competitiveness. Statements like those can communicate NCUA's risk tolerance. The biggest risk is this industry going the way of blockbuster video, print media, travel agents. That's the biggest risk, and I think that's what we have to think about. It's hard for a government agency because we focus a lot on short-term risks, and if our examiners are, then that's on us. That's management. But, it's like you're heading at the iceberg. Well, turning left, that has some issues. I'm a little nervous about that. Turning right has another set of problems. You know it's a total disaster? Hitting the iceberg. And that's what's going to happen if we as an agency, and this happens all around the world, put our own issues ahead of, put it this way, if we have the wrong measurement of risk, right? I compare it a lot to the stock market. What would be riskier? For those of us that don't have any family money, we've had this discussion. I have to create my own wealth for my family. I have to have my own financial security. I have to save and invest. What would be riskier for me and my family? Putting it into a savings account or putting my money into the stock market? Savings account would be vastly riskier if we're talking about long-term wealth here, okay? Vastly riskier. I wouldn't have any issues day to day. I wouldn't have to have, tough years like this one where you're watching the stock market and say, oh boy, am I poor today. But it would be vastly riskier to avoid short-term risk by putting my money into a savings account. The stock market is lower risk if you're thinking about long-term risk correctly, in my opinion, okay? So that's how I view these things. I think all I want to ask is, one thing we hear from credit unions is when they decide to innovate and try something new, and maybe it works out and maybe it doesn't, but a high capital credit union, right? They got maybe 16%, and they lower that to 13% to try something new, to try to find loan growth, right? They use technology, they try to innovate. Should they expect their CAMEL rating to dip because they've reduced their capital to spend money on new technology, for example, to try to get new loans, right? Because we've heard this complaint. Still, vastly more capital than required. If they spend money to innovate, still have plenty of capital, but it goes down measurably, will they expect their CAMEL ratings to dip in any fashion?
Not necessarily. I mean, it really depends on the holistic view of risks and the amount of capital that the credit union should hold commensurate to the activities that it's undertaking.
Did you ever have a computer virus before computers existed?
I did not.
Okay. Do you want to go back to a world? Remember, if we rewind and have no more computers, we have no more computer viruses. We can get rid of plane crashes tomorrow. No more planes, including life-saving aircraft. Anyway, I rest my case. Back to Chairman Harper.
Thank you, Mr. Vice Chairman. Board Member Hood.
Great, thank you, Mr. Chairman, and thank you, Jim and Rendell, for this afternoon's presentation on enterprise risk management. I often say that it's not about risk avoidance, but it is about risk management and risk mitigation. So I'm delighted, Mr. Chairman, that the board is considering the risk appetite statement before us today. Today's board item likely could have been done via notation vote, but I'm glad the chairman elected to do this in a public forum because it's a good opportunity to discuss holistic risk management for credit unions. Because, as you mentioned, Mr. Chairman, it allows them to see that we are doing just as what we're asking them to do. We are modeling by good behavior around what we're doing to look at risk and look at it holistically across the enterprise. It was also mentioned that I do care a lot about enterprise risk management because it's something that I really got a chance to work with when I sat here on the board well over 15 years ago. In fact, it was 15 years ago to this year, in fact, of January 2007, I launched an enterprise risk management series where we at NCUA were hosting conferences on this topic around the country. And the first one took place outside of here. It was actually in Washington, D.C. And our keynote speaker at the time was Federal Reserve Governor Susan Bice. And I'm just going to quickly read a quote from her. And again, mind you that this was said 15 years ago, if you bear with me. The financial services industry continues to evolve and to meet the challenges posed by emerging technologies and business processes, new financial instruments, the growing scale and scope of financial institutions, and changing regulatory frameworks. A successful enterprise risk management process can help an organization meet many of these challenges by providing a framework within which managers can explicitly consider how the organization's risk exposures are changing, determining the amount of risk they're willing to accept, and ensure that they have the appropriate risk mitigants and controls in place to limit risk to targeted levels. She goes on to say that a lot of this includes aligning the entity's risk appetite and strategies, enhancing the rigor of the entity's risk response decisions, reducing the frequency and severity of operational surprises and losses, identifying and managing multiple and cross-enterprise risk, proactively seizing on the opportunities presented to the entity, and improving the effectiveness of the entity's capital deployment. I end the quote from her speech. What she said 15 years ago could have been written and said on yesterday, so she was quite prescient in that. But what I want to emphasize today is that we have continued to evolve our ERM processes here at the agency since then. And I just would love to have one question, and that is, could you talk about how sophisticated and how our approach has evolved? And Jim, we sort of talked about this briefly when I passed you in the hallway. Could you maybe give some insight as to how we as an agency have really evolved in our sophistication when it comes to looking at ERM?
I'm sure I'd be happy to. I mean, I think that one of the things, as Rendell had mentioned, that we did not have before the creation of our ERM program was, a thorough and holistic way to review risks. And that is something that, as we have conducted our risk assessments, we've gotten better at it. As Rendell explained, the risk assessment of business diversification and credit concentration in credit unions has led to some pretty significant process changes in the examination process. And that's really, that's something for us to be proud of, because that helps reduce risk to the system generally. I think that, as Vice Chairman Hopman pointed out, sort of the way that we have put together the risk appetite statement with input from all of you really does give us a good, path forward and a way for the entire staff of the agency to consider further improvements and maturity in that program. Making it a true enterprise program that will help us, as an organization, make better decisions.
Very well. Thank you. I have no further questions.
Thank you so much, Board Member Hood. Is there a motion?
Yes, Mr. Chairman, there is a motion. I move that the board approve NCUA's risk appetite statement as attached to the board action memorandum.
Is there a second to the
I
motion?
second.
There is a sufficient second. All those in favor say aye.
Aye.
Aye. All those opposed say nay. Let the record show that the ayes have it, and the motion passed 3-0. Thank you all for being here. That is the end of our agenda today. There being no further business, we are hereby adjourned.
Hear, hear.